Hi, my name is Cynthia Carroll, and I've been practicing consumer bankruptcy law in Delaware for over 25 years. And I want to talk about COVID forbearances and how Chapter 13 bankruptcy can help, because there's a big misconception that I've heard often. A lot of people think that when they went out and got those COVID forbearances last year when the coronavirus first hit, that those mortgage payments that they didn't have to make are free money and they'll never have to face it again. And that is a mistake that could lead to foreclosure. So I want to talk about what a forbearance is, what a COVID-19 forbearance is, what happens at the end of the COVID forbearance, and that answer depends on whether you have a federally related mortgage or not, what your options are, and how Chapter 13 bankruptcy can help. So a mortgage forbearance is when a mortgage company agrees to temporarily pause your mortgage payments. Make no mistake, those paused payments have to be repaid or accounted for somehow. What is a COVID-19 forbearance? If you recall, when the coronavirus first hit last year, Congress enacted the CARES Act on March 27, 2020, and that required federally related mortgages to be offered forbearances if the homeowners requested it. So you could get a forbearance for 180 days and you can get a second forbearance for up to 180 days. And if you had a federally related mortgage, that was a requirement under the Act. But we found that a lot of conventional mortgage companies were also allowing forbearances to homeowners that contacted them and requested them. So what is a federally related mortgage? It's an FHA mortgage, it's a VA mortgage, it's a Fannie Mae, Freddie Mac, USDA. So if your mortgage falls into one of those categories, you have a federally related mortgage. Well, how can you tell? Well, for VA and FHA, all you have to do is pull out your mortgage papers when you went to settlement and take a look at the front of your mortgage. If you have an FHA mortgage, it'll have FHA in big letters on the first page of the mortgage along with an FHA case number. Same thing with VA. You'll have a VA mortgage with VA and a VA case number. For Fannie Mae and Freddie Mac, you would have to look that up, and there are lookup tools that are widely available on the internet. I'll put a link to those tools in the description of this video. And there's also a VA, and you'll have to call HUD to find out if you have a USDA mortgage. So if you have a federally related mortgage and your mortgage payments were up to date as of March 1st, 2020, then your mortgage company has to consider you for a loan modification. And if your loan modification is granted, then they will take those forbearance payments and put them at the end of the loan. If you have a conventional mortgage, reach out to your mortgage company and find out what options you might have available to you to cure those arrears that were caused by the forbearance, by the mortgage forbearance. Now, if your mortgage company gives you a plan that you cannot live with, or is it too expensive, or if you find yourself having to pay the whole lump sum in a short period of time, then you may want to consider Chapter 13. Now, there's two types of bankruptcy that you can file. Chapter 7 is a straight liquidation, short-term in nature. That's not going to help you in this situation where you have mortgage payments that need to be cured. You're going to need to file a Chapter 13. A Chapter 13 is technically called a wage earners plan, but it is a bankruptcy that's long-term in nature, anywhere from 3 to 5 years, and it requires that you make monthly trustee payments to the Chapter 13 trustee. And everybody has a custom plan. So at minimum, if you have arrears that have resulted from a COVID forbearance, at minimum, your Chapter 13 plan is going to involve curing those arrears. But you could use Chapter 13 while you're there for other purposes. One thing, you can discharge, in most cases, your unsecured debt, such as your credit cards, personal loans, repossession deficiencies, hospital bills, old income taxes that qualify. That's one thing. Those are some of the things that can be done. If you've had an automobile that you've had for at least 2.5 years, and the amount that you owe is substantially more than what the car is worth, you might be able to reduce your car payments and do what's called an automobile cram down. Sometimes, in some cases, you might be able to avoid or strip off a second mortgage. There are a lot of things that you can do in a Chapter 13 bankruptcy. And if you're worried about your credit, I do have a video here where I discuss the effect of credit. I've had several people, several of my clients, who've been able to qualify to refinance their house, to buy new homes while in active Chapter 13 bankruptcy, because they were able to rehabilitate their credit while they were in a Chapter 13 bankruptcy, and they didn't miss any payments to the trustee or the mortgage company during that bankruptcy time period. Now, I do have access that I give away free to anybody that files bankruptcy with me. I offer access to the 720 credit score program, and it's usually $1,000. I give it away free, and the people at 720, the nice people there, will show you step by step how to rehabilitate your credit. So if you have a COVID forbearance, try to work it out with your mortgage company. If you find you can't, Chapter 13 might be an option. So be sure to like this video, subscribe to the channel, share the video, and I'll see you at the next video.